our initiative to reach out to all of you on a weekly basis with an interesting topic every week. Today we have Mr. George Joseph, who is the CEO and CIO of ITI Mutual Fund, to discuss on a topic, what we call it as strategy to create long-term wealth. So strategy to create wealth, long-term wealth generally sounds like a topic where I'm sure you would have heard of it from many places, but it's always good to know from the horse's mouth directly, get a fresh perspective. What are some of the basic things what you should do right? That's what we will be discussing today. So welcome, Mr. George. We would love to have you today. And we have Shikhar from Groww. The flow of the program would be, I will start the session with a brief introduction, what is it you can expect from this topic and our opinion. And then subsequently, I'll pass it on to Mr. George, and then Shikhar will take over the session to talk about Groww as a platform, how can you make use of it, and so on. We would love to take questions from all of you. Please post the questions. We'll try to answer as many of them as possible. So without wasting much time, let's start with the program. I think long-term wealth creation as a strategy is something which in general we have some idea about, okay? But to set some basic ground rule, okay, what I have done is I have set in 3 key factors what one could keep in mind. To give you a quick introduction about myself, I'm Karthik. I'm into financial trainings. So the 3 key factors, the first one being asset allocation, second one being fund selection, and third one market timing. So these are the 3 factors what you would look at from my program. So talking about asset allocation, like now we see India-England test series is going on. It's good to take an analogy relating to cricket. Okay, imagine you are a batsman, you love batting. You want to form a new cricket team to go on a match and play with some other team. Just because you love batting, imagine you picked up all 11 batsmen and all 11 batsmen in the same batting style. All of you are aggressive batsmen. If that's the team what you have built for yourself, what are the chances that you would win the match? Very, very unlikely, right? I mean, imagine all 11 Virat Kohli kind of players in the match. It's very difficult that you would go ahead and win the match. That's why it's important for you to have batsman again with different temperament, someone who's like Cheteshwar Pujara who can stabilize the innings, but also someone like Rishabh Pant who can actually accelerate the innings. But you also need good bowlers and you also need wicket keeper and fielders. A right mix, not just having all 11 of them, but right mix also very important for you to go about winning the match, right? So same logic or concept would apply for asset allocation as well. Since last 1 year or so, we are seeing great equity market put on. I mean, if you were to say last 7-8 years or so, this kind of bull run is probably new for many of the investors. Imagine having all your money only in equities or only one category or one style of equities. What would happen? Okay, this is where we talk about asset allocation. Asset allocation means not putting all the eggs in one basket, trying to invest your money based on your goals and risk appetite. These 2 factors are there, but again, trying to give a mix of different asset classes. Okay, what could be the different asset classes? It could be based on what we call it as either gold or debt or whatever it is. So in general, when it comes to the matter of equity, what you could consider is adding gold to your portfolio when you're looking at long-term investing. Gold helps in reduction of overall portfolio risk, which involves on equity. So without actually going too much in depth into what is the basic concept itself, let me show you an interesting scenario. What if you have invested all your money in equity? Okay, say 3 flexi cap funds, 100%, say equal weightage, 33%, 33. The second scenario would be 70% of the money invested in equity, that is in same 3 multi-cap funds, versus and another 30% in gold ETFs. So how your portfolio would have looked like in the long run. Okay, so the chart what you see, okay, the orange line represents all equity. That means had you put in all your money in equity, what would have happened? Versus the green line what you see is asset allocation line. Okay, Right from 2007 calendar year till 2020 calendar year, the data has been taken into consideration. The starting point is you put in 100 rupees. Okay, 100 rupees invested in 3 funds, equally scenario 1. Scenario 2, same 100 rupees, 70 rupees invested in 3 funds, and then another 30 rupees in gold ETF. So the green line carries very relatively lesser volatility compared to the orange line. That is, all equity line would have higher volatility in your portfolio. But interesting factor to observe here is, okay, look at the 3 red circles. That is, especially when the markets go down, your asset allocation is actually helping you from, the downside risk, or it helps in reducing the downside risk. What does it mean? An asset allocation portfolio would fall lesser compared to an all equity portfolio. Okay, that is very, very important. Not just making money in the bull run, but if market trend were to reverse, how well you have covered yourself. Okay, that gets covered in asset allocation. So this is one strategy. The second one is fund selection. What kind of portfolios are there in your fund? That is also very important. Okay, in bull market, almost every investment of yours would be doing good. So then that means you don't really have to break your head. So how do we go about selecting best funds? We just go to Google and type best performing mutual funds, whatever you see in the list, top 3 or 5, whatever it is, you would invest in them. But what if some funds like sectoral fund or a infrastructure as a thematic fund would come in the search? What if you put in all the money in sectoral funds or thematic funds? This could be a fear, right? Many investors, by looking at the performance of 1 or 2 sectors, they might have put in all the money in there. The biggest challenge with sectoral funds is a particular sector, if you see, like pharma or FMCG or utilities, these 3 sectors does well. We call them as defensive sectors during bearish markets. But at the same time, bullish markets, there are different sectors which performs well, right? That means when you look at the economic cycle or the market cycle, there are different sectors which performs. So that's why it's important for you to identify, say within equity mutual fund category or equity mutual fund family, what are some of the all season funds? That means as an investor, you can invest into them anytime versus cyclical or seasonal funds. That means which are some of those funds which are seasonal performers. For example, like sectoral or some of the thematic funds are seasonal performers. So as an investor, if you're looking at long-term wealth creation, a large chunk of your money should go into what we call it as core portfolio, or we call it as all season funds. What could be some of the all season funds? Some examples, what you see on the screen: a large cap fund or a flexi cap, multi-cap, also read it as flexi cap as well. Flexi cap fund, ELSS fund, mid cap fund, okay, or index fund. Some of the index funds could be part of your all season portfolio. So selecting which category of fund you would be investing, that is also very important for long-term wealth creation. Okay, so that's the second strategy. Third strategy is, should I time the market? I'm sure even Mr. George would also agree and then probably be recommending the same thing. As an investor, your and my job is not to time the market. When markets are high, what should I do? Markets are low, what should I do? That definitely should not be our job. What is our job as an investor is to ensure from our income, start saving that money regularly and then start investing. Okay, so you could follow the SIP route, that is systematic investment planning route, which all of us are really familiar. We've been investing. I think that's one mantra we should keep in mind. Don't try to time the market. What matters is time in the market, for how long you stay invested. The next example, what I'm going to show, I'm sure all of you would have seen some other way you would have seen illustrations like this, right? So 3,000 rupees invested every month, okay, for 30 years. When I say 30 years, for 360 months. If your mutual fund portfolio gave you, say, 12%, that's an assumed return here, you would have got approximately 1 crore. Yeah, so this is an illustration. I'm sure all of us really would have seen it. That's why we do SIPs, so that we want to create long-term wealth. But one thing what we really don't think of is, I have met people who've been running SIP for last 5 years or 10 years, whatever it is. Imagine Your income also being same for last 10 years. You think you would be happy with that? No, right? You want your income to grow consistently every year. Only then you would be happy. Same logic applies to your investments as well. So don't just be happy with one SIP or two SIPs, whatever number of SIPs you're doing. Set a target that every year you increase your SIP by a certain percentage. It could be 5%, 10%, 15%, based on what you think is capable, you're able, you're able to do. We call this as step up SIP. It's very important for you to take this step also in order to create a bigger wealth. Simple example. What I've done is 5,000 rupee SIP every month. If you've done it for 20 years, 30 years, and 35 years, how much would you have got? Same SIP amount, 5,000 rupees every month for same. Same SIP amount would have given you about 50 lakhs at the end of 20 years, 1.76 crores at the end of 30 years, and approximately 6 crores at the end of 35 years. Second scenario is 5,000 rupee SIP, but every year you increase the SIP amount by 10%. That is, first year SIP is 5,000, second year SIP is 5,500. Just by doing that, look at the difference. At the end of 20 years, instead of 50 lakhs, you're almost getting 1 crore. And at the end of 30 years, you are getting 4.5 crores. And at the end of 35 years, you're almost getting 9 crores. Look at the difference. It's like almost double, right? And if you had increased the SIP amount by 15%, look at the difference. Over 35 years, you would have got almost 19 crores. So you get to hear about SIPs. How do you really take the maximum benefit of SIP? I personally think step up SIP, that should be one of your long-term strategy. So to put it in simple steps, three factors, what you need to keep in mind. First one being asset allocation. Okay, don't put all the eggs in one basket just because equities are doing well. Like diversify your risk there. Second one, select in right category of funds. Okay, always it's the basket of funds which will help you. Third, do your SIPs and ensure you increase your SIP value on a regular intervals. These are the three strategies what I personally think which will help you in growing a long-term wealth. Okay, to know more further, I would like to invite Mr. George. Looking forward for your session, sir. Thank you.
Thanks, Karthik. It's been a very interesting context that you have already set, saying that you have to select the right fund, you have to wait in the market, and also you have to have the right asset allocation. So I think it's a brilliant piece. I would like to share a small presentation along with I would like to say that how to create the long-term wealth. If you see, ITI Mutual Fund logo itself is long-term wealth creation. For long-term wealth creators is the key message that we want to leave it to all the viewers, that how to create long-term wealth. We have seen umpteen number of examples in the past, right? So people look at different asset classes at different points in time. Sometimes they go and invest in gold when the gold price is moving up. When the equity prices are moving up, they go and invest in equities, and they invest in national savings certificates or post office savings schemes, or bank deposits. Or invariably, most of the Indians are glued on to that. But ultimately, when they look at the end result is, they would not have made enough wealth to survive in their old age. So the key thing what you have to remember is that, for my last 30 years of experience, I started investing in 1991, thanks to my father, who has introduced me to stock markets. He gave me some money also in 1991. And he said, you can go and invest the stocks according to your wish. That is how I started. And over a period of time, I worked in the corporate treasuries, and then eventually in I'm managing money for the public money in the mutual fund side. What I've learned is that, you have to think long term. Very, very clearly, you have to think long term. without thinking long term, you cannot create long term wealth, right? So when you think about long term, what are the key things that you have to keep in mind? Most of the time, what you estimate in the future is generally, going to go wrong. You might think that next year COVID is going to be significant, then COVID actually doesn't become very significant. Next year, you think the government is going to change, but it might not happen the same way as you would have thought of. And you would have thought once the COVID crisis is set in, markets will go down. Actually, markets have gone up. But generally speaking, when you predict the future, you are playing with uncertainties, and most of the time you will go wrong. So that's the reason, you have to choose the asset class, and you have to stay with it, right? And you have to only do the allocation between different asset classes. Being an equity investor all through the while, the last 30 years, I can clearly say that the best asset class, which can beat inflation considerably well over a long period of time, is equities. Equities as an asset class is a brilliant asset class. There are very credible companies in India who can actually grow your wealth, which will grow, keep on improving their earnings on a consistent basis, and therefore the returns will come in those stocks. The beauty is that there are mutual funds which can actually, there are various mutual fund products available in the market, and there are various mutual funds available, and you can pick and choose the right products for your asset allocation. For asset allocation is nothing but, you are parking your money in different assets, be it equities, be it debt, or, be it real estate or gold, or, whichever the asset class may be. Nowadays, we have REITs also in the market, which is also more or less works like a fixed income instruments. So you have real estate investment trusts, gold, equities, the fixed deposits, and various options available in front of you. But you have to keep in mind that if you are a long-term player, equities as an asset class can do very well for you. So you need to have good allocation towards equities. India is a growing market. India can continue growing for the next 20 years, 30 years. There is no two ways about it, because the demography, the average age of Indians is only less than 29 years, which itself suggests that there is a huge room for India to do well. And we are one of the youngest countries in the world. Every foreign institution investor, everyone is looking at India as an opportunity to invest. And that's the reason, if you look at most of the banks are owned by the foreign institution investors, which are a proxy to the Indian economy. So we believe that the next 20 years, 30 years is going to be very robust for India to grow well. Even in our sleep, India is growing. 6% real GDP growth is given in India, right? Even in COVID happened, or otherwise, even the situations of various governments coming in and going out, we have seen actually India growing. When India grows at 6% real GDP and nominal, and also the inflation 6 to 7%, if you add up, your nominal GDP can grow at 11 to 13% CAGR for many years. If GDP is growing at 11 to 13%, your many companies in India can grow at upwards of 20%. So you have to pick and choose the right companies, and that is the duty of the fund managers like us. Which, when we are constructing the portfolios of equities, we will decide which stocks to be bought, which can do well in the long run. And maybe we are not buying the momentum stock where the value is available. When you're buying, there should be value available on the table. So as an investor, it is very important that, you need to have good allocation towards equities. If you're a young investor, if you have just passed out of college and, getting into the job, or, if you're if you're already on job and, have completed 10, 15 years into your job, then, probably your asset allocation mix has to be different. If you're newly into the job, the asset allocation has to be very different. And probably at your old age, your asset allocation mix can be very different. So it is up to you how to choose your asset class based on your risk appetite, right? If I am a very aggressive investor, I might say that, I want equities as an asset class, a big portion of my portfolio, because I think that, I can sustain the volatility, and, therefore the growth can be seen in my wealth. So definitely long-term thinking is required. choosing the right asset class, as Karthik also mentioned, is very much required. And within that, I just want to give a glimpse of it. Nifty is a proxy to equities, large cap equities in the country. It has given 22.95% CAGR over the last 13 years. So if you see that, there is a huge possibility that, if you look at from the last bottom of the market and compared it till recently, you have seen that, there is a huge run up in the equity markets, and markets have been going up the last 40 years also. Gold has given 10.5% CAGR. That is, every year it compounds at 10.5%. And post office savings is only 7.3%. NSC is only 8%. And PSU Bank FD is only 7.4%. And PPF is only 8%. So what it clearly indicates is that equities as an asset class, from the long-term investing point of view, it stands out. But you need to cough up the volatility. Equities will move up and down. Therefore, you need to be ready for the up and down movement. And therefore, you cannot get perturbed with the movements, and you have to invest into it. That's why SIP becomes a very good tool to invest in equities. And there are you can choose an asset allocation mix with a mutual fund, and you can invest into different SIPs, be it debt, equity, or other asset classes. So it's a wonderful thing to do if you plan your investments from a long-term perspective. Asset allocation is important, and that is very critical for your long-term wealth creation. Second part, what you have to remember is markets move through ups and downs. We have seen all the big corrections in the market in India, big crashes in India, has happened because of global reasons. In the year 2000, because dot-com bubble burst happened in US, therefore all the technology stocks fell massively in India as well. You saw in the year 2008, the global financial crisis, the Lehman Brothers crashed or collapsed in US. The subprime crisis was at the peak point, and therefore the markets in India also crashed in the year 2008. You saw in the recent times, March 2020, when the global crisis happened because of COVID, US markets corrected by 40%, and at the same time, Indian markets also corrected, even though in India there was no COVID at that point in time, or COVID has just started. Only 600 cases we had in March 2020. For all occasions when markets corrected, it was because of global reasons. For markets goes through ups and downs, and it gives you an opportunity. March 2020, we also wrote in Economic Times saying that it's a brilliant opportunity to go and buy equities aggressively in lump sum. Because when market crashes happen, that's not the time to do SIPs. That's the time to do lump sum investments, because that's you're getting equities at a very attractive valuations or very attractive price points. When you hear Nifty fallen 1,000 points or 1,500 points, or a bloodbath on Nifty, and those kind of headings when you see on newspapers, that's the time you can go and invest in lump sum into equities. You can go to Groww platform and go and invest into different mutual fund products very, very easily through in form of lump sum investments or SIPs. So what you have to remember is that markets goes through ups and downs. Secondly, you have to remember that there is when you say market is a composition of a bunch of companies. There are companies which are big, there are companies which are medium in size, there are companies small in size. Smaller companies are more vulnerable to economic shocks. Therefore, you have to be careful while you are entering into a small cap companies. That's what called as small cap companies. Mid-sized companies, they can withstand some sort of economic shocks like interest rate movements or oil price movements, but they are not very, very good quality companies, or they are not proven track record companies in real sense, because they are just emerging companies. And large companies or giant companies or super large companies, they are called large cap companies. They have humongous number of avenues of generating revenues, The multiple geographies they might be operating, multiple products they might be selling. They might be having different product lines or different business lines. Some of them are having telecom, petrochemicals and refining. Some of them are having retail. Some of the companies are having tobacco as well as FMCG. Different large companies are available in the market, which automatically means they are less prone to big shocks. And therefore, large cap companies are more stable. But, the returns are also in sync with the risk. Large companies are less risky. Therefore, the returns also, what you should expect from the large companies portfolio should be much lesser than what you should expect from a mid-sized portfolio. Now, mid-sized portfolio is less riskier than small cap companies. Therefore, the return that you should expect from a mid-sized company can be a little bit lesser than a small cap portfolio. So that's how the return risk the dynamics works. For you have to remember that when you're entering into a large cap, mid cap, small cap portfolios, you have to remember the valuation arguments also. Whether I am buying at the right valuation. Many times as a novice investor or as a layman, it is very difficult to understand the valuation metrics. It is quite easily available on various online platforms, online web pages, but you generally don't look into it. If you are a doctor, you know your profession well, but you don't know the investing profession. That's where the mutual funds come into play. You can give the money to professional fund managers who will manage it well, and we'll look at all these aspects, the interest rate movements, look at the price to earnings multiple, the valuations, the market situations, and finally they place the money relatively safely so that the investors' money doesn't go into vain. For always, valuations are important at what valuation level that you are entering. Like say, for example, last 1.5 years, markets have been running up. Now people are thronging for the new IPOs. The people are going and buying stocks like anything at this point in time. The retail participation is very high. Is this the best time to invest in equities? Or just think about March 2020 when everything crashed down and everything was available very cheap. Was that the best time to invest in equities? You yourself can understand, right? For March 2020 was far superior investing climate than today. For past returns may not be a true reasons, or may not be the right way to look at whether it is the best time to invest in equities. For maybe past returns might say that the fund has done very well. Probably that might not be the best time to invest into that fund. Or say, for example, historical performance, you need to analyze, to understand whether it is a stable 3 years, 5 years, 10 years. You look at the fund house level data, whether it has done well on a 5-year, 10-year basis, reasonably done well or not. Is that something which you have to look at? But if you look at on a 6 months, 3 months, this is the nature of daily NAVs, which is published by mutual funds. The tendency of the individuals is to look at the NAVs on a daily basis, and daily NAVs don't work, or daily performance doesn't work. Companies need to grow. Companies need to generate value for its own shareholders, and then the price will start moving up. So it takes time, to if you think about the entire investing climate, you need to think about the historical performance, whether it is sensible. Is it very high historical performance suggests that the market has been excellently done well? Maybe this is not the best time to invest. The past returns are very bad. Maybe that is the best time to look at it. So you have to think a little bit counterintuitively when you're looking at any asset class. It is not only applicable to equities, it is applicable to any asset class, be it gold, real estate, or equities, or debt instruments. This particular thing really works. Past performance may not be. That's why the disclaimer also mutual funds put in. Past performance may not be to be expected in the future as well. Now, I just want to clearly indicate the myth between volatility and risk. People get confused between these two things. Volatility is nothing but the stock prices moves. If you go and see the National Stock Exchange terminal with any broker, you can see the stock prices are fluctuating every now and then. That is volatility. What does it mean? The prices are going up, prices are going down. It doesn't mean anything to you, right? When the prices keeps going down, and if you have an understanding about the company, you know that the company is really good, and you know the fundamentals of the company, you understand the business of the company, then you know, and also understand the valuation of the company. Then volatility is you have to make volatility as your friend, because as volatility increases and the prices keeps coming down, as an investor, I want to buy this stock at this price. You might be having a fair value mechanism or intrinsic value in your mind that this stock at this price point is very attractive, and therefore it can give me in another 3 years time this much return. If you have that in mind, volatility can be your friend. So as the price fluctuates, you keep you keep buying that stock, or you keep buying that particular mutual fund. The same way, the NAV of a particular fund, that that fund house is good. The NAV is that particular fund is nice, and the fund manager is quite okay. If you know that all these facts, then when the NAVs are going down, this is an opportunity for you to buy, because the set of stocks what the fund manager has bought has gone down, and that's the reason the NAV is down. And when the NAV is down, do you exit from the fund? The answer is no. Ideally, you should be looking at investing more into that fund, and buying at a low prices, more units. That is what you have to think when the volatility hits in a particular fund also. Risk is what? Risk is buying something which is extraordinarily expensive stocks in the portfolio, or you're buying a bunch of stocks which are very badly managed companies, or corporate governance wise the companies are very bad. Then then there is a big risk in the portfolio, or you're buying into a particular sector which is actually deteriorating, or the business environment or the management quality is inferior, the sectoral dynamics is not that great, and therefore there is a possibility of a loss in capital. So risk is loss in capital which can potentially happen. Volatility is the daily movement in prices. The prices may go down and it will come back, but you don't need to worry about volatility. But risk is the permanent loss of capital which can happen because of the deterioration in the fundamentals. So you can be a friend of volatility, but you cannot be a friend of risk. You have to try to reduce the risk as much as possible in your, be it in asset allocation or be it in while investing into stocks directly. You need to be very, very careful. So what is the beauty of equity? I mentioned about equity as an asset class is one of the best asset class. And as a part of asset allocation, if you have equity, what is that you're getting? When you're buying equity shares, you would have heard of equity shares. Share is nothing but you're getting a piece of business. You're getting a share of the business. So you're getting the ownership in the business in which you are buying the shares. When you buy an equity share, you're getting the ownership in the business. When you're putting money into a mutual fund, equity mutual fund, you are actually buying a bunch of companies. You're getting the ownership in a bunch of companies. That's what is happening. Therefore, you might get dividends, you might get capital appreciation. All these things can happen. When you're an owner of the business, what you will think? Let the business grow. When the business grows, your wealth also will grow. Second is liquidity and transparency. You can sell the stocks anytime, and it is pretty much easily possible in the you go to a broker and sell the stocks. And that is the same thing which we do as a mutual fund. We sell the stocks through a broker. Capital appreciation happens. You can diversify your investments, various asset various stocks, so that various sectors exposures that can be taken, and excellent returns in the long run can be enjoyed. If you see Nifty or Sensex, in the last 41 years, Sensex has become 520 times. 520 times. Can you imagine? Which other asset class can give you this kind of disproportionate returns? But you need to have patience. 41 years, if you had put 1 lakh rupees, it has become 520 lakh rupees, 5.2 crores. This is the kind of wealth creation has happened in Sensex, which is 30 stocks index, which is published on a daily basis. So the wealth creation happens by ownership in the business. Index is nothing but a bunch of stocks, 30 stocks portfolio that you are investing into. But if you have invested into any of the mutual funds, predominantly most of the mutual funds have outpaced the indices on a long-term basis. 10 years, 15 years, 20 years, if you see, there are a bunch of mutual funds which has beaten the index considerably well and created wealth for the investors. So wealth creation happens. And the other good part about investing in equity is that you are getting the India growth story. India is the best country in the entire emerging markets, which is poised to grow for many years, be the young population, English-speaking population, and also highly enthusiastic, entrepreneurs in India. There are so many businesses, startups, which are happening, which can scale up over a period of time. And we are at the century where the economic growth is pertinent in India, even when we are sleeping, when we are sleeping, India can grow, and it can help beating inflation. So these are the key characteristics which you have to keep in mind while owning equity or allocating money towards equity. You have the ownership in the business, liquidity and transparency, wealth creation, and economic linkage. Let's look at equity versus debt over time. Equity versus debt over time has done exceedingly well. Equity has done exceedingly well over debt over the 15 years time. Therefore, I'm not saying that, I'm not against debt. Debt is very stable. If you see the yellow line, it is very stable. It is, it is very stable over a long period of time. But equities can go through ups and downs. But ultimately, equity beats debt on a long-term basis. If you have only short-term window, then you have to look at debt. Asset allocation, very, very critical. As I mentioned earlier, equity, fixed income, gold, and real estate, all these asset classes are very interesting. And, every asset class, there is an opportunity which will come in. You have to look at the past returns. If it is really bad, maybe that's the best time to look at that asset class, like 5-year, 10-year. If the asset class has not done well, especially in the case of fixed income or gold or real estate, real estate has not been, the physical real estate has not been doing well since 2012. For 2012-13 onwards, the physical real estate in Bombay, for example, you all know that it has not been doing well. But after almost 8 years, probably it has bottomed out, and maybe physical real estate also makes sense at this point in time. Gold, after a long period of underperformance, you get a sporadic outperformance period also. So when you have to be patient in that asset class, keep investing when things are not looking that great, and then wait it out for the better time to exit that asset class, or you reduce your exposure to that asset class. So if you have 100 rupees, how do you allocate money towards equity, fixed income, gold, and real estate? You need to definitely consult platforms like Groww, or you have to speak to a financial advisor. Consider portion of the allocation should go to equity because it's a inflation beating asset class. Some portion towards fixed income because you can dip into fixed income and it can give you regular returns. And fixed income instruments are also available in the mutual fund side. And gold as a very safe haven asset class. When everything goes down, gold goes up. So it is you need or currency or commodity or equity. When everyone lose faith in these asset classes, people go into gold. And maybe today the craze of Bitcoin is going on. Maybe Bitcoin, if it crashes, probably the gold might again come back into real glory. For assets, each and every asset class goes through ups and downs, bubbles and busts. When you see when we met when Mr. Warren Buffett came to Delhi, and when people asked him, sir, how did you make so much of wealth? So he said that I have been patient enough to buy into a crash or a bust period in the markets, and sell into a boom period in the market. Every 10 years you get an opportunity to sell into the boom period and buy into the bust. Say, for example, in the year 2020 March, if you had bought stocks, probably you can sell over a period of next 2-3 years, so that you sell into a boom period. Or say, for example, in the year 2008, if you had bought, you can sell between 2008 to 2018. You had a brilliant opportunity to sell those equity what you have bought in 2008. For when you buy cheap, and then keep on looking for an extreme optimism period to reduce the exposure towards that asset class. That is how the asset allocation happens. And There are products in the mutual fund space also, like balance advantage fund, which allocate money between equity and debt very seamlessly. Let's look at the journey which I mentioned about the Nifty from 1990 onwards. There was a technology boom in the year 2000, which got, and then there was a dot-com bust, which happened. Stocks like Infosys and, all the technology stock crashed. Then we saw global financial crisis in the year 2008, where significant meltdown happened. Then we saw massive small cap correction between 2000, between 2013 to 16 period, 2015 period, and mid cap, small cap, and also the general market correction also. 2013 was actually the bottom for small caps. And then we saw the COVID outbreak and markets correcting massively. So all these circles which you see are 4 circles where the market corrected massively, and it was a brilliant opportunity to invest into equities. Now, typically the problem of averages works in your mind. Generally, when you invest in equities, the thought process at which you work is annual return should be 12%. And this is what you're thinking in your mind. When you're investing in equities also, or any asset class, your thinking will be like, every year I have to get 12%. But market doesn't work in that manner. If you look at the 12% average returns, in reality works like this. Probably it works like this, right? There will be volatility. One year it went up 8%, next year minus 14%, next year 48% up, next minus 3% and 12%. This is how finally you arrive at the 12%. But during this period, stay put, not pulling out the money at the wrong time is what you have to look at. Otherwise, you will end up making much lesser returns. If you miss out this, say for example, you invested in the year 1 and you got 8%, and second year you pull out money, then you're actually at a loss. Then, third year you didn't invest, then you missed out the 48%. So if you're in equities, this is the way equity or any other asset class, probably this is the way the markets work, especially equities or real estate. We have to be glued on to the, your expectations have to be managed well. Now, 41 years, Sensex history, if you look at it, out of 41 years, 10 years, the red line as well as the small gray line, if you would see, these are the 10 periods where the returns have been negative. But otherwise, all other periods, the markets have only given positive returns. So what does it mean? It means that, if you have invested in the year 1980, 1984, you just be invested and, don't sell in between. You might see downticks, but ultimately India is a growing market, and equities in general will keep on compounding. If you are invested into Sensex, if you're invested into Nifty-based companies and sectors, and if you are invested into some of the good mutual funds, equity-oriented mutual funds, you just invest and wait. You will get a brilliant points where you can pull out the money. And when everyone is talking about, very high returns, when everyone is talking about, I made this much returns in equity and that much, then you actually, you have to think, is it the right time to be invested, or, maybe is the time to move out of that asset class? So if the exuberance is visible, when the shoe polisher also talks about equities, the panwala also talks about equities, that's maybe the time, maybe you will have to get out of that asset class and, or maybe reduce the exposure towards that asset class. But let me tell you, the best thing to do is that, buy and hold for long term. But, you have to try to look at these heuristic practices. When you see people talking about very high returns I made in the last 1 year, then maybe that is not the time to increase your exposure towards that asset class. Earlier, the better. Invest early and, you make mega money. There was example which Karthik also showed. I'm also saying the same thing. If you start at the age 25 with a 5,000 rupees SIP and total investment years 35 years, then total amount invested is 21 lakh rupees. But if you are having a 12% compounding return, which is possible, which is generally a lot of mutual funds have given over a long period of time, then you're talking about in 35 years of investment, your 5,000 rupees will become every monthly SIP will become 3 crore to 25 lakh rupees. So if you're started at 35, your total amount is just below 1 crore. And if you started at the age of 45, your amount is only 25 lakhs. So earlier the better. The earlier you invest, your money becomes 15 times. Mr. A, Mr. B, he made it only 6x, and Mr. C, 3x. For same return, but the timing, because the first guy invested for 35 years, second guy invested 25 years, third guy invested only 15 years. So the differential is massive. You look at the rolling returns. This also clearly indicates that, the longer, the better. So you have to wait at least 7 years for making a reasonable assumption that you will not make negative returns in equities. So 7 years is the mantra that you need to keep in 7 years plus. If you are investing in equity and you are entering today also, if you have 7 years at your hand, you will not, the chances of making negative returns are very remote. Right, 10 years rolling return for NSE 500 is zero instances that it would have given in the previous period. Maybe it is not the assurance for the future. But if you look at Nifty 50, again, 7 years and 10 years. For 7 years is the mantra that you have to keep in mind. If you have 7 years on your hand, you can invest in equities even today, and can wait it out for the next 7 years, and you will not be disappointed. But the starting point of investing, after 1.5 years of big bull run, if you are investing, obviously the possibility of a disappointment can be in the near term can be very high. So I would always tell my distributors as well as partners very clearly that after a big bull run, just wait out and wait for a better situation to start investing in bulk. But if you're doing an SIP, you can start even today, because that at some point in time market will correct. There could be, after a big bull run of 1.5 years from March 2020 till now, markets have been going up every day, and therefore there is a possibility that markets can go down for many months. And if that is the case, SIP is the best route to enter today. People are looking at the frenzy in the market, looking at the way some of the stocks are moving up. It gives me a feeling that maybe this is not the best time to put lump sum money into equities. This is the best time to put SIPs. This is the best time to look at your asset allocation very, very seriously. If you have invested heavily into equities, 100% is in equities, maybe this is the time you have to pull out some money and move your money into some of the debt mutual funds as well as gold and some other safer investments, so that you will not lose your wealth completely. As if you have a good asset allocation practice, you have a good SIP investment practice, I think you have done your job, and you can coolly focus on your work and leave it to the professional fund managers like us to manage the money. And you will have plenty time to think over many other things, and also take care of the you can see the wealth creation happening. For wealth creation mantra, as I call it, and I want to give in a nutshell in three key important factors which you have to keep in mind. One, you have to definitely practice asset allocation. You don't put all your money only into equities. Maybe this is the time to pull out some money from equities and move into some other asset classes. If at all, bulk of your money is only in equities, because after the asset class doing very well, I am talking about this particular situation. Secondly, probably the debt as an asset class, people are underestimating. There is a huge potential. Like, we have products like ITI Dynamic Bond Fund and all those things, in which are very, very nicely run products, where you don't need to understand the interest rate scenario. You don't need to understand, which part of the interest rate cycle we are in and things like that. And the fund manager manages it for you. So it is a very interesting products, like be it balanced advantage category or, dynamic bond fund category, or, those categories, or value fund category. These are all very interesting categories which are available, where you can park your money even today without much hassles of downside. So that's how you have to plan your asset allocation. And there are products within the mutual fund basket itself which can do asset allocation automatically. Maybe choosing those also makes a lot of sense. So what I would say is that, first, practice asset allocation. Secondly, you be invested most of the time, rather than, taking a judgmental call and moving out here and there. Rather, you look for long cycles, long market cycles, after a big return made in, for a period of time, then you can think about whether I should reduce the exposure towards that asset class or not. If real estate has done well for 5-7 years, then probably think about reducing the exposure towards real estate. If equities have done very well for 10 years, maybe there is a time to reduce the allocation towards equities. If debt has done exceedingly well for 3-4 years, probably there's a time to reduce allocation towards long duration bond funds. So you have to think about it very, very systematically. Now, if you don't have the capability to mull over all these things, the best thing is that go with the SIP route, so that there are no heartburns. You invest on a monthly basis. You also would not know that whether market is going down or going up. But you just take a stock of things. Once in 2 years, 3 years, 5 years. Evaluate those portfolios. That will give you a fantastic experience. So second point which I want to reiterate is give time, plan. Give time to your investments and be invested most of the time. Third thing is you have to believe in each and asset class in which you are investing in, and think about your risk appetite, how much risk appetite that you have, and then plan your allocation. Look for booms and busts. This is mantra which I learned from Warren Buffett. Once in 10 years, you will get a big bust period and big boom period. Utilize those boom periods and bust period. He said that in 60 years, he got 6 booms and 6 busts or 6 crashes. Those periods he handled the investments very well. He bought into a crash and he sold into a boom period. So, maybe buying is today, maybe next 10 years, you will keep on selling those. And again, you will get a big crash period. You buy into that. Again, you keep on selling as it moves up. So that is how you create wealth. And every asset class will go through these booms and busts. It might not be same 1 year, 2 year time frame. Debt markets goes through the booms and busts, longer horizon. Real estate, 7 to 10 year period. Equities, every 10 years, I have seen that, there is a massive sell-off period. Now the timing is coming down. Every 5 years, 6 years, you are getting an opportunity to buy into a crash period and, sell into a boom period. So if you utilize these things in mind, think about the market valuation, think about the, market cycles, and the booms and busts, you will be better off and have a very interesting experience. So I am a big believer of equities in the long run. Next 30 years is going to be brilliant in my view. India is going to grow considerably well, 12-13%. The GDP is going to grow. Many companies will grow 20-30%, and that is the duty of the fund managers to pick and choose the companies in the portfolio. So mutual funds actually can do wonders for you if you approach it in the right fashion. As a manufacturer of the products, I can clearly say we have been thinking about how to create wealth for our investors, and that is why the logo itself is long-term wealth creators for ITI Mutual Fund. So thank you so much, and over to you.
Shikhar will take over from you.
Yeah, over to you, Shikhar.
Thank you. Thank you so much. Hello, everyone. Welcome to Ab India Karega Invest. I will very quickly walk you through all the offerings that we have on Groww and the recent change that happened, and then we'll open the floor to taking your questions. So I will very quickly now share my screen so that I can present. Right. So as you all already know, investing, signing up on Groww is an extremely simple process. It's 100% paperless, all happens via your smartphone or your laptop. If your KYC is not done, we'll get it done, not a big deal. So I think if you're an Android app user, you're already familiar with the new changes we've made. This is something that you would have started seeing in over the last 1 or 2 months. If you're an iOS user, most of you would probably have received the new design. And if you haven't, then you will receive very soon. I'll just very quickly explain what happened here. As you know, on Groww, we are constantly adding newer offerings. So earlier we were mutual funds only, and then we went stocks. Then we offered gold. And right now, on the website, you have other things like you have FD, you have US stocks, and so on. So gradually, we're bringing all of these to the app. And the older design of the app was such that it could not accommodate that many products. So you change the design. So the design change is actually very, it is big in that it changes the very home screen that you land on. But after that, everything else is the same. So earlier you had at the bottom, you had three tabs. You had the Explore, Dashboard, and You. And now this has gone. And now what you have is you have three tabs: stocks, mutual funds, and gold. In the future, when we add newer things, you'll see them here too. This is what the mutual fund tab looks like. You can see there's an Explore tab and there's a Dashboard tab. From here, everything else is as it used to be. This would be very familiar territory for you. And the U button is now in the corner of the search, at the right corner of the search bar. So everything else from there is pretty much the same. You have the Explore screen where you have a list of popular funds, and then you have collections and so on and so forth. Likewise, this is the Stocks tab, the Stocks Explore screen. If you tap on Dashboard, you'll end up on your stocks holdings. So you can see that there. And likewise, this is the gold. Again, gold is split into two parts: Explore and Dashboard. And at any point when you type something in the search bar, you don't have to type only from within that tab. It's not like if you're on the gold tab, you can only search gold related items. You can search anything: stocks, mutual funds, and so on. The mutual funds page is more or less the same. As you can see, this would be very familiar to you. All possible details as an investor that you need to know, you'll find it here, be it past returns, holdings, fund manager name, similar mutual funds in that category, so on and so forth. Likewise, this is the stocks page. Again, not changed, barely changed, very few tweaks that we make to ensure that we make sure that it serves our latest feedback that we receive from our users. So minor changes we make all the time, but there's no revolutionary change in this part of the app. Likewise, this is the gold digital gold page. Right now, we are partnering with Augment Digital Gold, and that is how you will get digital gold on Groww. In the future, we might expand this to other offerings. Something that I always like to highlight, which is again from the feedback that we've seen, many users still don't know, which is mutual funds allows you to invest in a very varied manner. SIP or monthly investment is not the only way to invest in mutual funds. If you want to invest one time, you can do that. If you have an SIP already running and you want to invest one time in that mutual fund in which you already have an SIP, in most mutual funds, you can do that. And even if you have an SIP running, you can start another SIP. There is no limit. Practically speaking, there's no limit to the number of SIPs you can start. Exceptions are there. Some very few mutual funds sometimes allow only one time or only SIP, but by and large, most mutual funds allow you full flexibility. This is what the dashboard tab looks like. This is in case of mutual funds. As you can see, there's a list of all the mutual funds that you would have invested in. And if you tap on any of these mutual funds, you'll be able to see two options. They look like this. Two options are redeem and invest more. So if you want to invest more, you can tap that button. And if you want to redeem or take out your mutual money from that mutual fund, you can redeem. Keep in mind, if it's an ELSS fund, there will be a 3-year lock-in. So in that period, you will not be able to redeem. But all other mutual funds that are open-ended in nature, you can redeem anytime you feel like. There's a more details button at the bottom. If you tap that, you end up on a screen which looks very, it's sort of like your passbook. It has entries of all possible transactions in that mutual fund. So you can track when you invested, how much you invested, when you withdrew, how much you withdrew, the average NAV value, all of those things, very easily done. Import and switch. So this is one of the most important features that we have on our platform, very popular. Import allows you to track or import mutual funds that are on other platforms to Groww. So let's say you want all your mutual funds on Groww so that it's very easy to handle and monitor your mutual funds. And you have already invested in mutual funds on some other platform or via someone else, you can move them to Groww. just go to your mutual fund tab, go to your dashboard and scroll right to the bottom. There's an option there, import. Tap that and follow it from there. It's pretty obvious. It takes only 1 or 2 minutes, and then your mutual funds get imported within 1 or 2 days. Once you have imported, now many times this happens. If you have an investment outside of Groww, you would have been probably investing in the regular plan, wherein there's a small commission being paid. So when you move to Groww, you can switch that mutual fund from regular plan to direct plan where you don't have to pay a commission. So again, first you need to import and then you'll automatically be given the option to switch to direct. Groww Digest daily and weekly. So this is one property that we have. We send out newsletters Monday to Friday and on Sundays. This is excellent if you're a new investor. It contains all possible major news, jargon-free in a very simple language that you should know. And from the feedback that we receive, our users love these two newsletters because it simplifies everything, makes it very easy to understand. So if you have already signed up on Groww, you would be getting these emails in your inbox. Please do check it. In case it's not in the primary inbox, check the promotions tab. Maybe it's landing there. And if not that, you always have this link here, groww.in/digest. You can visit this page and read the digest. For any other doubts, any other questions, queries, please feel free to email us at support@groww.in. If this is not the only way to reach us, you can also go to the help and support section in the app or the website. And there are many answers there to the most common questions asked. Those would usually be able to answer your doubt. In case that is not the case, in case you're not able to find a resolution, you can raise a ticket and you can chat with us, or you can call us, or you can also email us from within the help and support section. Please do follow us on Facebook, Twitter, LinkedIn, and YouTube. We, especially with YouTube, you might enjoy it because we have many videos being uploaded that help new investors learn and get acquainted to the investment world. Many vernacular languages are also being included now. We have different YouTube channels. We have a Groww Malayalam channel, and we have a Tamil channel, and so on and so forth. So do check that out. And we do very often keep having initiatives like Ab India Karega Invest is one of those initiatives. Likewise, there's one that we're having on Sunday, which is called Thrive, where we on 15th August, which is on the occasion of the Independence Day, 75th Independence Day. And we've called some very noteworthy figures who will be speaking there. So do attend Thrive. You will definitely enjoy that event. It is 6 hours long, and there'll be many speakers. To receive an invite, you'll have to go to the link and register yourself. We'll just share that in the link in the chat box so that you can go and register in case you're interested. Yeah, with that, I come to the end of my presentation, and we'll now take your questions.
Yeah, thanks, Shikhar. So we have a couple of questions, Mr. George. I mean, our audience would like to know from you. The first one is, what should be a long-term strategy for an investor with a medium risk horizon? Should they go one time? I mean, if someone is looking to invest one time in a market like this, how should they invest? Should their portfolio be part of active funds or regular passive funds, or ETFs, and so on? What strategy you think they should follow?
Yeah, so I strongly believe that India is in a significant growth path, and there is a huge wealth creation opportunity in front of you. If you think about next 10 years, 20 years, so I don't think passive strategy is the best way to approach the whole thing, because India is still a developing country, and passive strategy can be interesting only in a country where the alpha generation itself becomes very difficult because of the size and scale of the economy. So if you see US, probably the alpha, the passive strategy is reasonably okay. So in that sense, if an investor with a medium risk profile, and if he's thinking about investing with at least 5 to 10 year horizon, I would say he can choose a bunch of equity funds in the be it a flexi cap or multi cap category, and also some of the debt funds where you need to have some cushion. So as we speak today, markets are at a all-time high. Today we're just seeing the tickers. Market is at an all-time high in Nifty as well as BSE, Sensex, and this is one of the, after 1.5 years of big bull run, it has reached a new pinnacle. It is not the best time to put all your money in equities at this point in time. So you have to allocate at least 30%. I'm just looking at a ballpark risk appetite guy in mind. I don't know the ultimately what is the kind of risk appetite the other person has, but I'm saying if you are looking at a 5 to 10 years horizon to invest even today, you should have at least 30% into debt category, as well as maybe 8 to 9% into gold. That would be the best way to approach the markets at this point in time, and then start investing on a systematic planning basis. So if you have 100 rupees, approximately 30 rupees can be in debt, and that too in a dynamic bond fund kind of fund, and balance 8 to 9 rupees in gold, and balance can be in equities. And that equities investment has to be invested through SIP route with the next 6 to 7 months SIP you can keep running, and that is a way that a lump sum that you want to put, you should allocate into equities in that manner. At least 6 months should be the minimum horizon that you need to keep in mind at this point in time when you're investing into equity. So you will have a good mix of different asset classes, some debt, some gold, and also equities over a period of next 6 to 10 months time. You can pile on to.
Sure. So the next question is, and I'm sure it's a very relevant question for a lot of investors, right? I think there are so many mutual fund schemes which are available even within just equity fund space. Let's leave hybrid and then debt funds aside. Even within equity funds, there are so many funds available or schemes available there. What are some of the factors an investor should keep in mind, and what are some of the ratios they could look at, according to you? If you can throw some light.
Yeah, so I think ultimately the style of the fund house has to be understood, or fund manager has to be understood, because what I would say is that it can be seen in the ratios also, because if you look at the information ratio or Sharpe ratio, it can give you a clear balance of risk adjusted returns. Right. So what is the kind of risk the fund manager is carrying in the portfolio, and vis-a-vis the return that it is generating? But the problem is that in India, nobody looks at the risk-adjusted returns ratios, and generally people go by only returns. Now, if you want to only look at returns also, the easier way to approach the whole thing is look at the past returns of you pick and choose a decent fund house or a decent fund manager, and look at the past returns of that funds. And if last 1 year, 1.5 years, if the returns have not been that great, right, then it means that if the fund is fairly defensively positioned, or the fund is very aggressively positioned, the returns will be always great. So if the fund is defensively positioned, maybe the last 1.5 years return might not be that great at the face of it. Maybe that is the best fund to choose today. That's the way I will approach my investments. Right, and rather than going into a high flying fund today, because the chances are that that fund can underperform in the next 6 to 12 months time. So choosing a fund is pretty easy. Go to the list of fund houses at this point in time, and look at all the schemes in the equity category. First you understand your risk appetite. If say first you have to decide at least whether you have some understanding about the large cap funds or mid cap funds or small cap funds. If you don't have that, go for a flexi cap or a multi cap fund. And then within the multi cap funds, then pick and choose the fund which is not done that great in the last 6 to 12 months or last 1.5 years. Then probably that is a fund you probably might need to latch on to at this juncture, so that your downside can be fairly protected.
That's a very interesting perspective. It's very few places where we get to hear, a perspective like this. So thanks for that. Next question is, while building a portfolio for, say, mutual funds for long term, again, from a wealth creation point of view, what kind of fund should be there? How should the portfolio should look like?
Yeah, so if you're looking at to build a portfolio, ideally you should have some large cap allocation for sure, some mid cap allocation, some small cap allocation also. Because India is a phenomenally growing country relative to the world, and the inflation and also the inflation in India is upwards of 6%, 5 to 6%, which is also very interesting. And GSEC yield itself is 6.5%, which is also very interesting. These kind of unique characteristics is not there in most part of the world, right? For GSEC yields are nearer to zero. The inflation is also nearer to zero, and people are struggling for creating scale in other parts of the world. For India is definitely a standout characteristics are available. For India is, if you are investing in India, maybe last 10 years, probably it was not the best time because India was going through a significant down cycle in the economy because of demonetization, GST, RERA, and various other things. So at that juncture, probably investing outside would have made sense because currency wasn't depreciating more. But next 10 years, my view is that India is going to be one of the best places to invest in and make money. And in that context, when you're constructing a portfolio, it should be most of India-centric funds, not going into global funds and things like that. I don't think it's worthwhile considering global funds at this point in time. So in that sense, when you're constructing a portfolio, think about some large cap allocation, some mid cap allocation, some small cap allocation. Choose the funds depending upon the history of the fund manager as well as the history of the funds, and also probably at this juncture when you're allocating, if you're doing an SIP is fine. If you're allocating a lump sum, obviously you have to think about the aspect which I mentioned earlier, and whether it is reasonably, it is not a high flying fund at this juncture. So if you have a mix of some gold ETFs, some, as I mentioned, 8 to 9%, you can have a gold ETF at this juncture. You can have 30% into a dynamic bond fund. You can have, maybe 10% into a liquid or overnight kind of, quick money kind of thing. If you want to dip in, that you can keep in the liquid overnight, or, you keep in balance in a dynamic bond fund. And 70% allocation or 60 to 63% allocation towards equity into a multi-cap. If you don't have the ability to pick and choose the large, mid, and small, then go for a multi-cap allocation. That will be a better way. So that is the approach that I would suggest an investor should choose from. Now, if you don't have the capability to do any of these things, better to approach a financial advisor who will be able to, or in the Groww platform, which will enable you to pick and choose the right mix of funds, which will enable you to create a good portfolio.
Sure. So one last question, and also $1 million question is, markets have really been phenomenally, well in the last couple of months. Be it large cap, mid cap, small cap, as a category itself, markets we have seen a universal bull run. But there are also people who are seeing there's a big bubble. Are we expecting a bust anytime soon in the coming?
Yeah, so I will go by what Howard Marks have taught me. If you read the Howard Marks is the founder of Oaktree Capital in US, and he has written books called Mastering the Cycles and Most Important Thing Eliminated. If you read these books, what he clearly teaches us is that you have to think about markets cycles. Markets will go through ups and downs, booms and busts, as I mentioned earlier. But at this juncture, I don't see it is in a bubble territory, because actually earnings growth is picking up after 12 years of slow earnings growth in the country. Corporate profitability GDP is around 2.2%, which is also near about year 2000 levels. So next decade is going to be very, very interesting. If I divide the markets into three parts, 1990 to 2000, we saw the technology, media, telecom boom, and then we saw the big bust happening in the year 2000. And 2000 to 2010 was infrastructure, capital goods, engineering, utilities, and corporate banks boom. There's a domestic cyclical boom. And that peaked out in the year 2010, and then all those stocks crashed. And then 2010 to 20 was only consumer-centric businesses doing well. So that was a 3-decade, and I was a part of this 3-decade investing as well. So in the last 2020 to 30, my view is, probably we are going back to the domestic cyclical boom. So it is just starting, and it can take steam as we move forward. Probably the last 10 years, whatever has worked might not work in the next 10 years. And that is something which investors have to keep in mind. It might not do as well as other domestic cyclical themes. So I believe, what we saw in 2000 to 2010 kind of scenario, more or less is going to replicate in the 2020 to 30. And we have to brace in for that. So earnings are at the rock bottom situation. It is just moving up, and it is only 3 quarters it has moved up. So it is not the time to worry about the market bubble. Yeah, one side, actually, markets are ahead of expectation at this point in time. Maybe at this juncture, when you're entering, you have to be cautious. And that's what our commentary has been from June onwards, saying that, be cautious at this juncture. But whether it is a complete bubble, the answer is no, because the earnings are at a rock bottom. When earnings peaks out, like what we saw in the year 2007, and market peaks out on top of that earnings, that's when, you need to be really worried. Probably, there could be a quick sell-off in a bull market. Generally, the sell-off has been very brutal. So quick sell-off in a month's time or 2 months' time, you might see, and those kind of things can happen anytime. But that is not what I'm saying. And, if you see May 2006 is an example, even before market getting to a new high, Nifty corrected by 30% in 1 month, 29% in 1 month. So those kind of quick sell-off is possible because of the big run-up which has happened. And, some froth will go away, and, then the market cycle again starts. And the earnings growth catch up also happens. So I think, brilliantly speaking, if you are an investor, this is the time to start your investing with the next 10 years in mind, and not at the next 1 year in mind. If you have only 1 year in hand, this is not the time to invest. If you have 10 years in hand, probably this is the time to start your SIPs, start allocating money. At least 70% should be in equities, is my view at this juncture.
So great. So thank you so much, sir, for being part of this. Thank you very much, everyone, for being part of today's Ab India Karega Invest. I wish all of you very good luck and have a great weekend ahead. Thank you.
Yeah, thank you, Karthik, and thank you, the entire Groww team, Iraj, and everyone. And, I think it is a brilliant platform. I wish all viewers and investors to take this opportunity to use the Groww platform well and, invest wisely. Thank you.